Joining us now is Michelle Meyer. She's the chief U.S. economist at Mastercard Economics Institute. And Michelle, much like Ted Rossman of Bankrate told us yesterday, you think the consumer is still holding up. Is that right?
Well, I think we have to be careful when we talk about the consumer in this environment because we know that there's a number of things that are shifting. We've talked about the uncertainty fog that is here in part because of the policy environment. That's important. You do see that consumers change behavior when they're faced with uncertainty. But you also have to consider other dynamics. The end of last year was very strong. We had a very, very positive holiday shopping season, spending on durable goods, spending on experiences, probably fueled by a positive wealth effect. And then you hit this lull in the beginning of the year, in part because of weather as well, which we know was playing a role in a number of the names that you just talked about before. So I think we have to be careful. We have to take a step back from some of the noise and look at what's driving the consumer overall. And to me, not that much has changed other than uncertainty. So you look at the hard data. You know, Ted yesterday for Bankrate was looking at the hard data, and this gets into this divide where the sentiment is terrible. Does that typically, do you take that as a leading indicator, or do you dismiss it because of the politics involved? And I don't mean that the respondents are politically motivated. I just mean that because so much uncertainty is coming from the White House, it's not like a typical business cycle. Yeah, it's definitely not typical, that's for sure. And the uncertainty is heightened, so we cannot ignore that. We have to pay attention. But before we can have a proper appreciation of the trend forward, you have to be able to understand what's happening in the hard data. And there's many times where the soft data will fluctuate, will send a strong signal, and it doesn't end up showing through in the hard data, or it does so temporarily, and then we resume the course that we were on before. So to me, what will be indicative is if you actually see behavior precautionary savings kick in, if you see the consumer change in terms of their basket of spend, and very importantly, if you see businesses change how they're investing in their workers. We had initial jobless claims out this morning, still at very low levels. The JOLT survey is still holding in very close to where it's been. Last jobs report, 150,000 jobs were added, even though you had those cuts on the federal workforce. That's all really, really important as you think about the path ahead, in addition to monitoring surveys and uncertainty trackers.
Steve?
You know, I want to just layer in something that Tom Lee said when he talked about the idea that maybe they're going to delay or change these April 2nd tariffs. And my immediate thought was for myself, and does that mean more Sundays working on tariff stories? But then I thought about the market, and I thought, does that delay or continue the uncertainty further? When Michelle talks about higher savings, that does not bother me one bit. If Americans have more money to save and save more now, it just means they'll have more money to spend later. That's not my problem. My problem would be if you have higher unemployment, if you have companies holding back on business investment. I agree 100% with Michelle that right now the fundamentals of the consumer should be good. We went through a cold January. They held back. But if you looked at that last personal income report, they had higher income and lower spending, and the savings rate went up. That's good for the future. I do not believe that sentiment is something that for the long term will keep people from spending. But what the administration would want to do, it occurs to me, is get this uncertainty behind it as soon as possible so the consumers can get on their regularly appointed rounds of spending.